Welcome to the ISG's quarterly call summarizing the second quarter of 2019. My name is Howard Coleman. I'm the Chief Investment Officer of Coldstream, and with me today is James Walsh, the Portfolio Manager for Kevin Fitzwilson's team and for the Asgard Dividend Growth Mutual Fund. We will be providing a market recap, and we'll be discussing our special topic, which for this call is on a unique phenomena that we've only seen recently, which is negative interest rates, primarily in Europe and Japan. While we have scheduled this call for 30 minutes, please bear with us if we run over by 10 to 15 minutes so that we can cover these topics thoroughly for you. Now I'm going to start with the market recap. The second quarter of 2019 again demonstrated that the markets in the US have the ability to go up, even though we've had a nice run this year and they've gone up very nicely this quarter. In the second quarter, as you can see, US large cap, again, the S&P 500 was up 4.3%, the best performing asset class. The Russell mid cap also did nicely at 4.13. And for a change, international equities, you can see there MSCI EAFE, the EFE, was up 3.68%. It essentially performed along with US equities, which it has significantly underperformed year to date. As you can see, it also significantly underperformed last year. The interesting thing about the second quarter is that in May, we were actually down in that month over 6%. There was big concerns at that time about a trade war. Again, Mexico came into the picture with Donald Trump being threatening to close the border. And in June, the Fed came to the rescue. The Fed saying that we indeed, essentially signaling that they intended to cut rates, and the market interpreted that as cutting rates more than once, which caused the markets to significantly rally in June, showing that nice return. The other interesting thing that doesn't always happen, and has happened more recently than it has historically, but both stocks and bonds rallied together. As you can see in the Barclays Ag Bond, US investment grade bond, that was up 3% when stocks were up 4%. So pretty much all asset classes, with the exception of some commodities, had a very nice quarter. And this year at 20% year to date, we'll take it. James?
Particularly after last year. Yeah, so you can see the performance. This is the S&P 500 over the last 3 years. It's basically a tale of two tapes. On the left-hand side, we have the strong bull market that we experienced at the end of 2016 all the way through the early portion of 2018. That drop you see there is a 10% drop right there in the middle of the page. That's Trump's first tweet on surprise tariffs on China. And the market's basically been moving in tandem with developments on the trade front, and when they've gotten worse, the market's gone down, and when they've gotten better, the market's gone up. And a couple of developments over that time frame. The market peaked, and that middle peak there is in the late September of 2018, and then trade negotiations fell apart right around that time, and the market declined. Q4 of 2018 was nearly traumatic in its decline. It was a 20% decline, which is just awful to experience. And there's a confluence of factors that were affecting that. It's not just trade, but it looked like at that time that the Fed was going to continue raising cash rates. You also had a government shutdown that was pending, and again, the deterioration of China and U.S. trade relations. In that period, though, Trump and Xi met, declared their eternal friendship for one another, and that they would resolve their trade issues and defer further tariff increases. That did not assuage the market. The market kind of panicked still after that moment. And the Fed even at that time was coming out with very dovish statements in that they were not going to continue raising rates if the global trade situation continued to get worse. And then so the market recovered all the way through March and into April. And then we had May, which is a down month. And that was like Howard alluded to, the decrease the potential tariffs on Mexico, opening up a second trade war front, which would potentially be very bad for the U.S. economy if it were to come to fruition. Fortunately, Mexico and the U.S. came to an agreement very quickly. I mean, it was literally over the weekend.
Yeah.
And You also had dovish statements out of the Fed describing decreasing interest rates, like literally dropping interest rates in the face of this trade uncertainty, and that gave a boost to the stock market.
Before you switch, just one other comment. Technically, this is a good-looking chart. The red line, as you'll see, is the 200-day moving average, and the blue line is the 50-day moving average. And we've really blown past those and gone past our previous highs. So from a technical perspective, which is accurate sometime, but not always accurate, it's accurate.
Slightly better than a coin flip.
Right. It's looking very strong.
I would point out that the low in May coincided with the 200-day moving average as support, which is, again, that's a pretty good technical signal there.
Right.
Now, the small cap market does not look the same. And it's a little tough to kind of parse out why this is happening. I mean, we all have our own guesses. My particular guess is that the S&P 500 is dominated by tech and software companies, and tech and software companies continue to do very well in this business environment. While international trade has been tough, you know, if you're trying to source any material goods out of China or finished goods out of China, you're having a hard time at this point with the tariffs. You're likely trying to diversify your inputs by going to other countries like Vietnam and diversifying your supply chain, and that's causing a lot of uncertainty. So if you're an industrial company, you're in a tough spot here. Whereas if you're a software company, these software companies don't have the same China trade barriers, and they continue to make more money. And there's also, you know, an underpinning change that's happening in the global economy in the use of this software. The cloud itself is changing the business environment that we're in. And so you're seeing large uptake for cloud companies, you know, AWS at Amazon and Microsoft's cloud. Those companies are growing revenues at a fantastic rate. And so that's manifesting itself in the S&P 500, whereas the small cap market doesn't really have the same dynamics. You don't have large software companies in the small cap index. You tend to have our smaller industrial producers, transport companies, banks, and those companies are not doing as well in this environment. Internationally, the markets have, you know, kind of shored up here. You know, we're basically at a new status quo of very low rates of return, very low rates of earnings growth. China slowing down on trade with the United States, and the trade conflict with the United States has hurt Europe. There's an obvious contagion effect that's happening there, and it's also happening in Japan. And this index is composed of European and Japanese stocks with a small component in Australia.
Yeah, and I don't think it's widely recognized in the US, James, but Germany has, as a percent of its GDP, has a much bigger exposure to China than the US does in terms of their auto imports and things like that. So the spillover effects from the trade war have a lot more to do with, well, don't only have to do with US and China, it have to do with Japan and Germany.
That's absolutely true. And then we have the emerging markets, which is this index is actually becoming increasingly more and more Chinese. I think it's about 25% Chinese right now, heading towards 50%. The composition of the stocks in this index are actually literally changing to be Chinese. But there's the emerging markets. It's Latin America, it's China, it's all the countries that surround China, and it's also Eastern Europe. And you can see that this chart, this is a 3-year chart, pretty flat over the last year and a half. Essentially, the trade war kicked this off, the decline in the stock market chart. You can see that in the middle of the page. Again, that's Trump's first tweet in February of 2018, declaring the opening of the trade war.
Just one other thing on the emerging markets. As we talked about in the last quarter, the emerging markets in the last quarter did not, their markets did not respond nearly to what the international developed markets and the Fed did. And in both the Fed and the international developed markets, you had the Fed, you had ECB, and the European Central Bank and the Japanese Bank indicating that they were becoming more and more dovish. China is stimulating, but the rest of the emerging markets, it's not affected by central bank policy to the same way that you have 1 or 2 or 3 central banks that can really move the markets. In the emerging markets, you don't. And so that what they call the put by the Fed, the fact that they're going to cut, which juices people into equities, doesn't exist in the same way in the emerging markets.
So valuations, this chart's 25 years of the forward PE ratio on the S&P 500. And that's a fancy way of saying, what is the market price, the expected earnings over the next 12 months? And so right now we're sitting at 16.74, and you can see the 25-year average is 16.19. This isn't well, you can look at the chart. It's a rare observation. The market doesn't typically trade at fair value. It tends to trend between an absurdly high valuation, absurdly low valuation. It doesn't hang out at central tendency much, but that's where we are. I think there's a balance of very cheap money out there. If you're a company, you want to borrow, your costs of borrowing are very low, but then earnings expectations, are cloudy. We're in the longest economic cycle we've ever had. And if you're forecasting earnings over the some forecastable horizon, call it 3 to 5, maybe even 7 years, there's a lot of uncertainty to that earnings estimate. And so if you're going to have uncertainty, you're going to have to discount those earnings. Even if you believe earnings are going to grow at some fantastic rate, given the fact that there's uncertainty around those earnings expectations, you have to bring that valuation down just a little bit. And so here we are sitting at fair value. Howard alluded to the idea of a Fed put. And the idea there is that if the Fed's going to be market responsive, every time the stock market declines 10, 15%, they come in to save the day by lowering interest rates. Well, all things being equal, that means that the stock market's a little bit safer. And if it's safer, you could probably justify a higher valuation. And we'll get in later when we get into discounted cash flow analysis and how you value a cash flowing asset. If interest rates truly are declining, there's room for this market to grow to a higher valuation level given those lower interest rates, if we do get some certainty around what those earnings are going to be. But right now we're sitting at fair value, so it's neither, it's not a green light. I guess it's kind of a green light. It may be coming up on a flashing yellow, but it's not a red light, and it's certainly not like a gigantic buying opportunity at this point, but it is sitting at fair value.
So this is a chart on investment grade bonds and the yield on investment grade bonds. So please remember that the yield and the price act inversely. So as the yield falls, the price rises. And really the point I want to make here is what we've seen recently, as I mentioned earlier, is a correlation between investment grade and equities, because the yields have fallen, they've compressed, and a spread really means what's the difference in yield that you can get between a US Treasury and an investment grade bond. And so people were buying investment grade bonds at the same time they're buying equities. Historically, you think of them as risk on, risk off, but right now they're correlated. People are trying to get yield any way they can, and investment grade provides an opportunity to do that. High yield spreads have also are also relatively tight, but I want you to see they have been tighter. They're not historically as tight as they have been in 2018, 2017. That blip, the big blip in 2016, as you can see, more a mountain than a blip, was the energy crisis. And when energy yields fell so low, about 20% of the high yield market is energy. And the market got very, very nervous at that point, and spreads, what they call spreads, blew out. Now they're tight, but they're not historically tight.
So this is one of my favorite charts. This is the leading economic indicator. It's a summation of 10 different data points on the economy that tend to lead the economy. And this chart's a lot easier to read than the other versions that we've used in the past. If it's in the red, that means that the leading economic index has fallen for 6 consecutive months. And that has typically happened. When that typically happens, we've usually had a recession that follows pretty quickly thereafter. And as you can see, it's been trending down and down and down ever since trade became an issue. So for the past year and a half, it's been in decline. It is not yet in the red zone. I will say though, the latest tick, which was the June number, was a decline, and it declined primarily on the Purchasing Managers Index, which is one of the components of the LEI, basically flatlining. It reads, reading on the PMI of 50 or above is flat to growth. Below 50 is contraction. It read 50. And so that was decline. Housing starts also declined a bit, and unemployment claims actually ticked up a little bit. So we're watching this very closely. In terms of portfolio policy, generally you want to start playing hard defense once this thing goes into the red and stays there. You can see there's a couple false positives on this, but discretion being the better part of valor. I mean, it's better to make an error on defense likely because you can correct that and get back into the market. But once the market starts to cascade down on recession, it tends to cascade further and further, and those opportunities to play defense ebb away. Fortunately, this LEI tends to be pretty early before the market declines. I mean, like on the order of 6 to 9 months, and sometimes years. Had you used it as a stock market timing tool back in 2006, you would have been out of the market for a while before the market actually collapsed. The market really collapsed in October of 2008, and you would have been out of the market for a while, and you'd be looking funny at your financial advisor if you were out of the market all the way from 06 through middle of 2008. Then you would have looked heroic, but yeah, that's another story.
Just one final addition that those of you who work with James or Darren or David know that of all the indicators, we don't simply rely on one here at Coldstream, but this is probably number one in importance of the things that we keep our eye on.
And it's not binary. You have to take it in context, and you have to look at the components themselves, because there is some context around each of these changes. One of the indicators in here, and we'll discuss this a little bit, is the yield curve. And the yield curve is a very important indicator, but what you want is the mosaic. You want, not necessarily all of them, but maybe the majority of these indicators all turning negative. Not being, because this LEI, I mean, it's a composite of individual indicators. One particular indicator can lead the whole thing down, but if that's idiosyncratic, something's happening in the housing market, but nowhere else, or in something happening in the industrial market but nowhere else. So like likewise in 2015 and 16 when the energy markets were crashing, that was actually a good thing. Low oil costs mean consumers have more money. Consumer spending employs a lot more people than the energy markets, and so you do have to put this in context, and you can't just simply trade on it as, automatically.
Here's a positive chart, and this is real GDP. Real GDP being what does GDP look like minus inflation, and it's increased year over year in 10 of the past 11 quarters, up till the first quarter of this year, just steadily increasing. Certainly the tax cuts on corporations help this, but it was increasing even before that. Now, 3.2% in Q1.
That was a surprisingly high number.
A very surprisingly high number. And I think all of our expectations are that for Q2, we are going to see a change in this. We are not going to see no predictions that I've seen, including the Fed's predictions, call for anything close to 3.2% change in the second quarter.
Likely 1.5 to 2%.
Yeah, so we're going to see a significant fall in this quarter, which leading economic indicators, the first word is leading. So those have turned over a little bit. So you could expect on a lag time GDP to turn over a little bit. So that the leading economic indicators we'll see after the second quarter are showing the slowdown that we're finally seeing in GDP.
And I would say a lot of this, tax policy matters, particularly in the way it was done. The corporate tax cut, corporations knew that they were going to essentially be getting a windfall, and going to a territorial tax system, meaning that those foreign sourced earnings could be repatriated, meant a lot of money came back to the United States, and it did manifest itself in GDP. Now, to Howard's point, this is a lagging piece of data. Over the past 6 months, 9 months, it's really all been about trade uncertainty. And so the idea that corporations are spending their windfall continuously has gone away. Like they're not continuing to spend like they were spending in these timeframes. They've ratcheted back the capital spending quite a bit.
To James's point. The next chart, this is CapEx, which is capital expenditures, which is corporations investing in themselves. Now we can see that the red line is planned capital expenditures and the blue line is actual. We can see that the actual has fallen off significantly, and in large part that is because of confidence, because of trade tensions. And we can also see the divergence between planned CapEx and actual CapEx. And that is also a sign of some concern on the corporate front about the future. So this is something else we are keeping a strong eye on as an important component of the mosaic, as James talks about.
Okay, so as we discussed earlier, what are the best leading indicators? Like if you're on a desert island and you had to pick one, you'd probably pick the yield curve. It has one of the longest and best histories of forecasting recessions. A normal yield curve looks like the green line that you see on the screen at this moment. The green line is where interest rates were on the treasury market 1 year ago. And what you have on the x-axis there is the term. So in the middle, basically in the middle of the page, you see there's a 10-year line. That's the 10-year treasury, and the yield on the y-axis on the left-hand side was trade. So that 10-year was trading at 2.85% 1 year ago. And then all the way on the right-hand side, you can see the 30-year treasury bond was trading at just under 3%. And then on the front end of the curve, the 1 month, 3 month, 6 month, 1 year, those interest rates are substantially lower. That's what a normal yield curve looks like. Generally, you want more interest for the longer you lend money. It means you're losing opportunity. If you lend out your money, you don't have access to it. It's gone. It's out there. The treasury is using it, and you want a higher interest rate for the longer the term. And then you get into today, and today looks like that red line. You have this big U shape in the middle on the front end, or on the kind of the middle there, middle of the term structure. And generally what's happening there, in a closed environment, and you just have investors acting on their own interest and expectations of where interest rates are going, what they're doing when they accept a lower rate than the current prevailing cash rate is that those investors anticipate rates will be lower in the future in the time frame that you see it there. So the market's essentially saying that interest rates will be lower between 6 months and 8 years, 9 years from now. And in that period of time, interest rates will be low. Now, generally, the reason that interest rates are low, particularly this kind of move, is because you're in a recession. Something bad has happened. And it can either, there's two shapes of this, right? You can just have an extremely low growth environment and call it a 0% growth, and interest rates would be low on that. Or you have a shock where you have negative interest rates for a short period of time and then positive rates somewhere out there. No one can tell based on the shape of this curve whether, what scenario the bond market's actually pricing in. But the bond market's certainly pricing in lower interest rates somewhere in the future. And that's actually now essentially been confirmed by the Fed. The Fed Powell's come out and they're essentially contemplating 3 rate cuts. I think the futures market right now is pricing in 100% probability of a 25 basis point cut in July at the end of this month. And then the potential, very high odds, call it 70% plus, that we get another rate cut somewhere in the September timeframe, and then somewhat 50-50 odds, I think, for a December rate cut. If you were to apply those cuts to the current curve, that would fix this curve. The curve would be essentially flat. That red line would be flat all the way through, call it 6 years, and then start ascending out there to the 10-year. And so some other mitigating factors here, well, we don't live in a bubble. The United States is not the only economy in the world. Global investment funds can invest anywhere in the globe. They have the opportunity to invest anywhere they want. Contextually, Europe and Japan have negative interest rates. Their rates have declined over this period, this 1 year period here that you see where the yield curve has shifted. Their rates have gone negative. Well, if their rates are negative and you're an investor in Germany or Saudi Arabia, anywhere, and you can get 1.8, that seems like a fantastic deal relative to 0 or negative that you would get on a German or Japanese bond. And so that has to have some influence. And it's probably also having influence just on the Fed themselves and their decision making. If those interest rates are negative or 0 overseas, and our interest rates are positive, particularly on cash, that would have an effect of strengthening the dollar vis-a-vis foreign currencies, in which would make it difficult for our exporters to be competitive.
So this is our last slide on market update before we go into negative interest rates, and I think it's a nice segue from one to the other. This is European and U.S. inflation, and this is using in the U.S. the CPI, and you can see the green line is the U.S. inflation rate and the blue line is the European inflation rate. What I want to point out is if we look at 2008 and pre-2008, you had a higher level of inflation than you've had post 2008. And we're at 1.6% in the CPI. The Fed uses a slightly different measure of inflation, but they want to get inflation and keep inflation up at around 2% and have inflation expectations, what people think is going to happen in inflation in the future, higher, because inflation typically tracks stronger growth. So if we have stronger growth, we're typically going to have higher inflation. James, when we talked about the yield curve, remember how much lower the 10-year yield is now than it was a year ago, and that's because inflation expectations have come down. As you can see, inflation expectations have come down, and prospects for growth have come down. So the Fed wants to lower rates to get inflation expectations up, which would also cause yields on the 10-year bond to go up. But as James said, as we'll talk about now, you can't look at US rates in isolation. You have to look at it in conjunction with rates in the rest of the world. And so now let's talk about negative interest rates, and James will talk about kind of what's happened with central bank rates over the past several years.
So you can see there's a pretty big divergence here. The top line, the green line there, is the Fed funds overnight rate, and it started to escalate basically continuously off the zero bound, basically starting in 2015. I mean, we had a quarter point in there, but they've continually been raising rates. At the exact same time, both Europe and Japan started decreasing their overnight rates. So European growth has been stymied for essentially since the Great Recession. They had a second recession, a double dip that happened in 2012 based on their austerity. And well, one, they raised their cost of capital with their overnight rate cash rates, and then they ran austerity budgets through their government to fix what was at that point called the Euro crisis. And from that point forward, they've tried to correct that mistake with lower and lower interest rates. And so at this point, they're negative, we're positive.
I just want to make sure this sinks in because it's so remarkable. You are actually paying the Bank of Japan and the European Central Bank to own their debt. They are not paying you. You are paying them, which is remarkable.
And this is the 10-year rates. So our 10-year bond tends to be less influenced by monetary policy. The Fed can manipulate long-term rates through a process called quantitative easing. They haven't been doing that for a while, and they've been actually tapering off their purchases. But they have a less influence, and this is generally set by the market. And it's the rate is usually correlates to what GDP looks like, because there's that, like we alluded to earlier, there's a real cost of capital out there, and there's an inflation expectation component to it. And this rate should be positive most of the time, but now we're looking at a period where both Japan and Europe have negative interest rates, and Germany in particular. And so what's happening there is that Europe and Japan are both running quantitative easing programs concurrently at this time. They've set their cash rates to negative, but they've also been essentially printing money on the ledger and buying almost all of the entire quantity of sovereign debt that's out there. So between the European Central Bank, the Bank of Japan, the pension funds that are required to have this sort of collateral, and banks that have to have collateral that's of sovereign quality also, they're hoovering up all of the supply and causing these negative interest rates. And that has the effect of forcing investors out to find something else.
And it's nothing short of staggering regarding the amount of negative yielding debt in the world. In US dollar terms, there's over $12 trillion of negative yielding debt. So again, I want this to sink in. $12 trillion of when you borrow money and when you lend money, and pay for the right to lend money. It's as if you had a mortgage and the bank was paying you. And James talked about part of the reason, but this is not only, and we'll see in a minute, it's not only government debt that's running negative, some corporate debt is running negative as well. And there are the mandates. They are as James says, hoovering up the government debt. But there's also a reluctance in the retail market, into the individual investor, to buy stocks. And they are buying negative yielding debt as well. Part of it is, I think there's the demographics in Europe and Japan are much older generally than in the US. And I think for a 65 or 70-year-old person to own a lot of stocks is a little risky, especially after 2008. And so take a little bit of a loss and bet for
they're a bit stuck. It's the devil you know, right?
Yeah, exactly.
You know, locking yourself into a negative yielding bond, you know precisely how much you're going to lose.
Exactly.
Throwing yourself into the stock market, you have no idea how much you might lose. And particularly like in Japan, Japan's market has not appreciated in 30 years. It's not like United States where continually we can look back at periods where the S&P 500 has continued to escalate and appreciate in value. The Nikkei has done nothing. So if you're a Japanese investor, zero return is better for your savings than some uncertain, unknowable quantity out in the future, which has a coin flip probability of being lower or higher.
Right. And also professional traders are buying negative yielding debt, because remember, yields and price are inverse. So one can buy negative yielding debt and make money if rates go more negative, because then price will go higher. So there are some folks out there thinking it's just going to get worse,
rates can get more negative,
and they will make money on this. So it's a confluence of problems, but historically we have never seen anything like this before. And this is really the most remarkable thing. So this is corporate debt. This is the percent of the markets that are corporate debt. Now, BBB rated means investment grade, but it's the worst, it's the lowest level of investment grade. 12% of the BBB market is negative yielding. And the circle at the bottom, BB rated, that's junk bonds. The phenomena of junk bonds being negative rated is remarkable. Now, these are probably all short dated and they have a call provision in there. In other words, they're expecting the corporation to buy it back, so they probably won't lose that much money. But the fact that you would have a junk bond that is negative rated is just historically, it's not negative rated, but negative yield is historically unprecedented.
It's particularly absurd when you think that you look at the EFI index, was that Europe and Japan index, you can get a 3% yield on that. Like there's a positive 3% cash yield that you can earn on the EFI. But investors are either by charter required to own fixed income, or somehow by choice picking this to invest in rather than an equity market with a strong dividend yield.
With high yield though, James, no one's required to own high yield. That's not all by choice. For BBB.
No, that's not necessary. If you're a high yield mutual fund,
yes, correct,
you have to own it. No, so someone out there is required.
You're right. I was thinking of bank charters and insurance, but you're right. A high yield mutual fund does have to own.
But when you think about typical pension fund allocation, right? They designate years in advance what their asset allocation is going to be. They're going to have a sleeve dedicated to high yield.
Right.
Those high yield buyers are required to buy those things.
And you know what? Ironically, you're picking up yield over high yield versus investment grade because the negative rate is lower.
You are improving your loss situation by buying that versus sovereign.
Exactly. Yeah. Exactly.
Great. This starts pretty interesting, and it's terribly convoluted, so I apologize in advance. What you're looking at, the yellow line and the white line, are the current holdings of U.S. Treasuries by Japan, Japanese individuals and entities, and the UK entities. And you can see the quantity has been increasing over time. That green line is the US 10-year Treasury interest rate inverted, meaning as it goes up, the rate has been going down. And the reason I threw this on the chart in the way I did is to show the very tight correlation. Foreign buyers have essentially driven our interest rates down, and it's visually very apparent. And this phenomenon has been particularly acute over the past two quarters here, 2.5 quarters. And again, that's a result of active policy decisions that were made by the Bank of Japan and the ECB. That they have publicly declared they want interest rates lower. that they will continue to extend financing to banks at absurdly low interest rates and continue to keep their sovereign debt at negative interest rates. And so that's caused investors of all stripes to buy more U.S. Treasuries, and that's going to have an influence on our yield curve. And I think this is part. It's not 100% of the explanation, but it is a strong driver of the move that we've seen in the yield curve and why it's U-shaped at this moment.
I want to add something to this because this has befuddled a lot of analysts. There are many analysts that predicted that when the U.S. and China entered into their trade war, that would cause rates to rise because China has historically recently been the largest buyer of U.S. Treasuries, and they have cut back significantly on their buying. So people thought, oh, who's going to buy Treasuries now? What's happened is Japan, UK, and Australia have stepped in and ramped up their purchase of U.S. Treasuries even beyond China's cutback. So that has really supported Treasuries. I want to make one other point before we go on to analyzing the mechanics of how negative rates work. You may have been reading about Deutsche Bank and other European banks struggling significantly right now. And negative rates are designed to spur the economy. And European economy GDP is doing a little bit better, but it really hurts the banks. Banks are required to hold reserves in the US at the Fed, in Europe at the European Central Bank. In case there's a run on the bank, in case there's deposits, they have reserves to make up for it. And in the US, they pay interest on those reserves. With negative rates, the bank has to pay the ECB for the right for them to be regulatorily required to hold those reserves. So they're losing money on the reserves. It's essentially a tax, but at the same time, those reserves are set off against deposits. And actually deposit rates in Europe are still positive. They're about 30 bips, 0.30% for retail investors. So the banks are taking a big hit on the difference between their reserves and they're paying out retail investors. Yeah. And it's a very difficult situation for those banks.
So why does all this matter? The short version is interest rates matter because that's how we value things. The term structure of rates, the absolute rate itself matters in context because how does one value a cash flow that comes into the future and what is that current value? And generally speaking, when you have high interest rates, valuations are lower, and when you have low interest rate, valuations are higher. And by lowering interest rates, what the Fed is doing, what the ECB is doing, the Bank of Japan is doing, is they're trying to, one, stoke inflation, and they're also trying to increase the asset values of any good. I mean, it could be a cash flowing good or it can just be a consumable. By dropping that interest rate, it becomes more valuable today than it would be otherwise in the future. And so the way we can demonstrate this, I mean, it's just a math problem. We're going to do some slides here that are a bit remedial and going back to school. So I apologize, but it's nice to see, how the whole math works out. But $100 today is worth $100 today, right? If I pull out a $100 bill, Howard pulls out a $100 bill, we'd freely exchange that to one another. There's no expectation of gain or loss, and we would do that until we grew bored of the exercise. But what if Howard wanted to borrow $100 or borrow some amount of money and agrees to pay me back in a year? Well, the prevailing interest rate is about 5%. I'd be willing to give about $95 to Howard for $100 1 year from this day, right? That's $100 discounted by 5%. So it's important to put context around what that 5% came. Well, how do you come up with that? Well, there's different components of interest rates that you can break out. The first component is generally, this is why the sovereign rates are so important, is what's considered the risk-free rate. And it's the interest rate that one would apply if they expect no risk of capital loss, meaning that the that the debtor is going to pay back all interest, all principal, nearly assuredly. And so that's typically a sovereign rate. You could generally think about, the U.S. Treasury. It's never defaulted on its debt. It's always paid its obligations, and you have a reasonable assurance that it could continue to do so. And it's the rate that the government gets to borrow, and it's typically considered the risk-free rate.
That's the rate you should charge me.
Howard is not risk-free. I've seen him. He has spilled coffee. It's kind of a klutz. There's definite risk to your ability to repay interest and principal. But this risk-free rate has a couple components. The general ones that we look at is probably the most important is the expected inflation rate over the period to be experienced. So in our 1 year example, if I expect inflation to be 5%, at a minimum, I want 5% for the time value of my money, because if I simply wait, I'm going to get essentially that rate of inflation. And I also want to be compensated for the real rate. Basically, this is the true time value of money. This is the opportunity cost of the money. I could be doing anything else. And so at times when economic activity is strong and profits are strong, the real rate is usually pretty high, because I can go buy Microsoft or something that has a reasonable assurance of growth. And so to induce me to buy this bond, I'm going to have to get some sort of real rate. But sometimes real rates go to zero, and that's generally when you're in a recession and you have no expectation that Microsoft or anybody else is going to be able to make an earnings growth number. If their earnings are actually in decline, this real rate could be negative. And so all you want was the expected inflation. But we're also encountering periods now where expected inflation is zero or potentially even negative, deflation. Well, if that's the case, this risk-free rate can continue to go down to that zero or even negative. If you truly expect inflation and the real rate to be negative, then a negative rate is somewhat justifiable. There's also an element in there that typical in the bond market, they're called the credit spread. We watch this all the time, but this is just the rate that given kinds of borrowers of different credit quality are charged above and beyond this risk-free rate. And there's something another concept that's not on this page, but it's the equity risk premium that you could also apply to this risk-free rate in terms of discounting future cash flows. So generally, a corporate dividend stream has a real risk of either not occurring or being very variable. It can decline, it can go up, and that is very akin to a credit rate, a credit spread essentially. And that the more variable the potential dividends may be, the higher the equity risk premium that you would apply to that discount rate. And so you stack these up, and that's how you discount those future cash flows. And so I've got a little example on here. What if you want $100 paid out over 4 years, assuming that flat term structure, that constant 5%? You'll notice, well, $100 from a year from now is worth more today. It's not $95, but if you spread it out at this 5% discount rate, you apply an annual discounting mechanism there, the dollar amounts decrease. So basically the value of a stream of $25, it's still $100, but it's paid over 4 years, and your opportunity cost, your risk-free rates are at 5%. You'd be economically equivalent paying $88 for that stream of returns of those cash flows. And so if interest rates drop, you get a drop from 5% just across the board. The value of that asset goes up. That cash stream all of a sudden became more valuable because the discount rate is smaller. So the prevailing rates here dropped 200 basis points. The present value of those cash streams increased by 5%. Now, what do you get into negative rates? Now this is where we get silly. There's no textbook that even contemplates negative interest rates. This is not a phenomenon that's ever existed, but it kind of, you can see it works on paper here. So let's assume that this term structure remains flat, but we've gone to a negative 1% interest rate across the board. You've got 4 years of negative 1% interest rates. You're still going to get that $25 nominally across those years. The value of that asset basically is $102.57 with a negative interest rate. It is literally worth more today than the sum of all the future cash flows. And what does that mean? Well, it means that you should spend your money today. Like consuming your cash today is more worthwhile to you because the purchasing power is going to decline over time. And you have more buying power now. And this is exactly what the ECB, is trying to accomplish, and the Bank of Japan is trying to accomplish. Spend your money, goose the economy. I mean, what they're really trying to do is create inflation. They want to enforce the investors out of these risk-free assets and into riskier assets like credit or equity markets that inflates asset prices and makes people kind of feel good. But ideally, it's pushing people into productive assets that employ people and capital and essentially deepen the economy. And at a minimum, force people to spend their money to get that capital flow going. Now, so that's the mechanism. If interest rates continue to decline, you can expect higher asset prices. An interesting observation, though, is that we actually haven't seen this manifest.
Exactly.
It's real because the math is certain, right? I mean, the math is the math. But the other component I kind of alluded to earlier is just that the equity premium that you require at the same time that the rates are falling, the yield premium you require goes up. The risk premium you require for an equity holding has gone up because there's real, true risks to that outlook, and so you have these countervailing factors that have not, it's increased bond prices. Don't get me wrong, the bond prices have gone up, but equity prices have not. We have not observed an equity premium or an equity price premium being priced into either European or Japanese stocks, even though their interest rates are negative. Which I find interesting, unless maybe it's just manifesting itself in the S&P, because that's the equity index that's at all-time highs.
I think we talked about. I think it's part of it is just the demographics of Europe. They don't want to invest in equities or Japan in the way that we do. They're more afraid of them.
Yeah.
That's the only explanation I can think. But economically, it has had an effect, a positive effect on employment. It has not goosed inflation, although you don't, but there is the unknown, which is what would have happened if we didn't have rates. Would it be worse? And there's no way to measure that. But it certainly hasn't, to this date, really achieved the results they were hoping it would when they implemented it. I think that's fair to say.
That is fair to say. We continue to not see inflation manifest. Now, it could be just, we would have had we not entered into a global trade war or in trade conflict.
Perhaps,
right? I mean, that's truly stymied growth across the globe.
Correct.
I mean, it's been a global phenomenon, and it's an important factor to consider.
And I think that's in large reason why the Fed is cutting and the ECB is re-stimulating.
That's right.
They are trying to counteract the impact of the trade war.
Yeah. So just to get a little more speculative, I mean, Howard, I can certainly see the environment turning in the United States to where we can get to a zero interest rate environment. Now, I'm not going to go all the way out on the limb and say we're going to go negative, because I think at some point we're going to, particularly like you described, it hurts bank earnings to run a negative interest rate. It doesn't hurt bank earnings all that much to run a zero. And we had a Fed policy post-financial crisis of a zero Fed funds rate. And then we ran QE, which drops the quantitative easing, which dropped the longer rates. So kind of the mechanism I see where the scenario I see where the US can see these kind of negative interest rates, global trade tensions are ongoing. They continue longer than anyone foresaw. We get escalation of these trade tensions where we continually try to outdo each other by raising tariffs, and you get into a true trade war, and that truly stymies any kind of capital equipment spending, payrolls. Eventually this is going to hit corporate earnings, and you can get this downward spiral, and you can get, it doesn't actually have to send us into recession, but it can send us to a zero growth rate environment. Inflation expectations go to zero. That risk-free rate drops down to zero, and now we have a flat yield curve environment at essentially zero rates.
I think if a trade war forced us into a recession and inflation expectations came down to zero, and why inflation expectations are important is, as James was talking about, it's a component of what interest rate you'll demand. Because if inflation's at 5% in 10 years, you're going to want to be getting more than 5% on your coupon to make up for inflation. So if inflation's at zero, you're not going to really demand as much on your coupon for your bond. So inflation expectations are important. It's really one of the things that probably the biggest thing the Fed is focused on in cutting rates. So yes, if inflation expectations came down, we went into a recession, that would be a possibility. I do not see that as the base case. I don't think you do either.
No.
That's not what we anticipate happening. It is a possibility, but we don't want to scare you to say, yeah, we're going to zero rates, because I don't think we are. But that would be the path that would take us there without question.
But yeah, I mean, some unforeseeable economic shock hits us. It's certainly possible. I actually think, Trump has a really limited window here in these trade negotiations. If he really wants to run on a strong economy, this cannot continue. And so I think he's got through fall. Then he's got to resolve this stuff. Fed will have already lowered rates, basically setting us up for a pretty decent 2020. Now, what happens after that is anyone's guess, but.
Yeah, well, as we said, we will keep a close eye on what happens with the LEIs and a close eye on what happens with the yield curve, as well as looking at the other economic data in, talking about what to do with your individual portfolios. So thank you very much for your listening to this and your patience, and we hope you enjoyed the call. We'll see you next quarter. Thank you.
Thank you.